Before your next Social Security deposit hits your bank account, there is something important you need to understand. Right now, the Internal Revenue Service, the Social Security Administration, and the United States Treasury are connected more tightly than ever before. They are sharing information electronically, matching records automatically, and flagging discrepancies faster than they used to. For seniors living on a fixed income, even a small reporting mistake can lead to letters, delays, overpayment notices, or unexpected tax bills. This does not mean something is wrong with your benefits. It means the system is more precise, and precision works both ways. Let me explain why this matters. For many years, retirees thought of these agencies separately. The Internal Revenue Service handled taxes once a year. The Social Security Administration handled your monthly benefit. The Treasury simply deposited the money into your account. It felt like three different lanes. Today, those lanes overlap. When your employer files your W-2, that wage data goes straight into Internal Revenue Service systems. The Internal Revenue Service shares verified earnings data with the Social Security Administration. If you take money from an individual retirement account or a 401k, the financial institution sends a Form 1099 directly to the Internal Revenue Service. If you earn bank interest, that is reported too. The Treasury processes payments using systems that verify identity and account information electronically. Here is what this means for you. If the numbers you report do not match the numbers your employer or bank reports, the system notices. This does not happen years later, but often within months. When the system notices, it generates notices automatically. Now, I want to be very clear. This is not about a new law targeting retirees. It is not about cutting Social Security. It is about data matching and enforcement becoming more automated. My goal here is simple: help you protect your income and understand how these systems actually work so you are never caught off guard. This is where many people get confused. They assume small differences will not matter. Maybe you estimated your part-time income at $18,000, but it ended up being $21,500. Maybe you forgot to factor in a bonus. Maybe you withdrew an extra $5,000 from your retirement account late in the year and did not think about the tax impact. Individually, those feel minor, but electronically, they are data points. Let us take a real-world example. Imagine you are 64 and collecting Social Security early. You are allowed to earn up to a certain annual limit before benefits are reduced. For every $2 you earn above that limit, $1 in benefits can be withheld. Now, suppose you thought you would earn $20,000 for the year, safely under the limit, but overtime pushes you to $23,000. That $3,000 difference matters. The Social Security Administration did not withhold enough during the year based on your estimate. You could receive an overpayment notice later. That letter might say you were paid $1,500 more than allowed, and that recovery will begin from future checks. Most people are not expecting that. It is not fraud, it is math. The reason it gets caught is because Internal Revenue Service wage reports and Social Security Administration records are cross-matched electronically. Now, let us talk about taxes. Many retirees are surprised to learn that Social Security benefits can become taxable depending on total income. The Internal Revenue Service uses a formula called provisional income. It includes your adjusted gross income, any tax-free interest, plus half of your Social Security benefits. If that combined number crosses certain thresholds, up to 50% or even 85% of your benefits can become taxable. Imagine this situation. You are receiving $24,000 per year in Social Security. You withdraw $30,000 from an individual retirement account. That withdrawal gets reported on a 1099-R to the Internal Revenue Service. Suddenly, your provisional income crosses the higher threshold. Now, a large portion of your Social Security becomes taxable. You might not feel it immediately because taxes are not withheld automatically unless you request it. But when April comes, the Internal Revenue Service computer sees the numbers clearly. If there is a balance due, and it is not paid on time, penalties and interest can apply. This is not about creating fear. It is about understanding how connected the systems are. The Treasury's role is also important. The United States Treasury runs payment processing and manages the Treasury Offset Program. That program can collect certain qualifying federal debts by offsetting federal payments. Most retirees never deal with this. But if someone has unresolved federal tax debt or certain defaulted obligations, Treasury systems can apply offsets automatically after due process. Because everything is electronic now, it does not require manual review in many cases. Another area that has tightened is direct deposit verification. If you change your bank account information, Treasury systems often verify account ownership and identity data. If there is a mismatch, perhaps your name appears slightly differently on the bank account, the system may pause processing briefly for review. Usually, it is resolved quickly. But if you rely on that deposit for rent, groceries, or medication, even a short delay can feel overwhelming. Here is the core issue. Automation reduces fraud. That protects the system long term. But automation also means discrepancies surface quickly. Small reporting errors can trigger automatic letters. Letters trigger deadlines. Deadlines create stress if you are not prepared. Most of the time, these situations are fixable. They just require a timely response. The good news is this. When you understand how Internal Revenue Service, Social Security Administration, and Treasury data matching works, you can avoid most common problems. Report earnings accurately. Keep track of retirement withdrawals. Review your annual Social Security earnings statement for errors. Open mail from the Internal Revenue Service or Social Security Administration promptly instead of setting it aside. These are simple steps, but they matter more now than they did 20 years ago because the system is faster, the system is automated, and the system compares numbers across agencies. Let me say something reassuring. Your monthly Social Security check continues under current law. Benefits are still being paid. Millions of payments go out every single month without issue. This conversation is not about losing benefits. It is about protecting them. Here is what this means for you in practical terms. If you work part-time, keep good records and report accurately. If you withdraw from retirement accounts, understand the tax impact before year end. If you change banking information, double-check that names match exactly. If you receive a notice, respond calmly and promptly. Knowledge prevents surprises, and in retirement, surprises are expensive. Now that you understand how closely the Internal Revenue Service, Social Security Administration, and Treasury systems are connected, let us talk about the actual reporting rules that affect you directly. This is where many people get confused. They think once benefits start, everything becomes automatic. But certain things still require attention, especially if you work, withdraw from retirement accounts, or receive other income. Let us start with Social Security and taxes. Whether your Social Security benefits are taxable depends on your total income. The Internal Revenue Service looks at something called provisional income. That includes your adjusted gross income, any tax-free interest, and half of your Social Security benefits. If that combined number crosses certain thresholds, part of your benefit becomes taxable. For single filers, once provisional income exceeds $25,000, up to 50% of benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Here is what this means for you. Even if Social Security is your main income, withdrawals from individual retirement accounts, part-time wages, pension payments, or investment income can push you over those lines. For example, imagine a married couple receiving $30,000 combined in Social Security benefits. If they withdraw $40,000 from an individual retirement account in the same year, a large portion of their Social Security could become taxable. If they did not have taxes withheld during the year, they could owe several thousand at filing time. That is not a penalty. That is the formula working as designed. Now let us talk about earnings limits. If you collect Social Security before reaching full retirement age and you continue working, there is an annual earnings limit. If you exceed that limit, benefits are temporarily reduced. Generally, for every $2 you earn above the limit, $1 is withheld from benefits. In the year you reach full retirement age, the formula changes slightly. After full retirement age, the earnings limit no longer applies. But here is the important part. The Social Security Administration relies on accurate wage reporting. If you underestimate your earnings when you first apply and your final wages come in higher than expected, you may receive an overpayment notice later. That is because the system recalculates once official wage data is received from the Internal Revenue Service. This happens more often than people realize. Now let us talk about self-employment income. If you are self-employed, the Social Security Administration looks at your net earnings, not gross revenue. That means after business expenses. However, those numbers must match what you report to the Internal Revenue Service. If there is a difference, it can trigger a review. Because self-employment income can fluctuate, underreporting or late reporting can lead to overpayments that need to be repaid. Another area that surprises retirees is required minimum distributions. Once you reach the required age, you must take minimum withdrawals from certain retirement accounts each year. Those withdrawals are reported to the Internal Revenue Service on Form 1099-R. If you forget to take the required amount, the Internal Revenue Service can impose a penalty on the shortfall. If you take more than required, that higher income can affect your tax bracket and the taxable portion of your Social Security. Then there is Medicare. Higher income can also affect your Medicare Part B and Part D premiums through what is called the Income-Related Monthly Adjustment Amount, or IRMAA. The Social Security Administration uses Internal Revenue Service income data from prior tax years to determine whether higher premiums apply. If your income spikes one year due to a large withdrawal or property sale, you could see higher Medicare premiums 2 years later. This is not random. It is data-driven. Finally, if you ever receive a notice from the Internal Revenue Service about taxes owed, from the Social Security Administration about an overpayment, or from the Treasury about a payment issue, do not ignore it. Most notices include deadlines for response. Ignoring them can allow penalties or recovery actions to move forward automatically. Here is what this means in simple terms. Accurate reporting protects your benefits. Understanding income thresholds prevents surprise tax bills. Responding early keeps small issues from becoming expensive problems. The rules are not hidden. They are written clearly in official guidance. But they require attention, and when you understand how they work together, you stay ahead instead of reacting after the fact. Now, let us talk about what actually happens if something goes wrong. This is the part that makes people nervous. Penalties, overpayments, offsets, garnishments. Those words sound heavy, but when you understand how they work, they become manageable instead of frightening. Let us start with the Internal Revenue Service. If you are required to file a tax return and you do not file on time, the Internal Revenue Service can apply a failure to file penalty. That penalty is typically calculated as a percentage of the unpaid taxes for each month the return is late. If you file but do not pay what you owe, there can also be a failure to pay penalty plus interest that compounds daily. Here is what this means for you. If you owe $2,000 and ignore it for several months, that balance can quietly grow. Not overnight, but steadily. The Internal Revenue Service will send notices first, multiple notices, each one explaining the amount owed and options for payment. Most retirees who respond early can set up installment agreements. The Internal Revenue Service does offer payment plans, but if notices are ignored completely, collection action becomes more likely. Now, let us talk about Social Security overpayments. Overpayments usually happen because income was higher than estimated, work activity was not reported promptly, or eligibility changed. When the Social Security Administration determines that you were paid more than you should have received, they send a written notice explaining the amount and the reason. By default, the Social Security Administration can withhold a portion of future benefits to recover the overpayment. In some cases, they may propose withholding the entire monthly check until the balance is repaid. However, individuals can request a lower withholding amount based on financial hardship. This is where many people feel overwhelmed. But here is the important part. You have rights. You can appeal the overpayment decision if you believe it is incorrect. You can request reconsideration. You can ask for a waiver if the overpayment was not your fault and repayment would cause hardship. The key is responding before the deadline printed on the notice. Now, let us bring the Treasury into this conversation. The Treasury Offset Program allows certain federal debts to be collected by offsetting federal payments. That can include tax refunds and, in specific cases, portions of other federal disbursements. However, there are protections and notice requirements before offsets occur. Again, this process does not start without written notification. Here is what this means in practical terms. Most financial disruptions do not begin with money disappearing unexpectedly. They begin with a letter. Letters come with timelines. If you open the letter, read it carefully, and respond within the allowed window, most issues can be managed. If you ignore it out of fear or confusion, the system continues moving forward automatically. Let me say something reassuring. These agencies are structured systems. They follow procedures. They are not emotional. They are not random. They operate on documentation and deadlines. When you provide documentation, respond clearly, and keep records, you put yourself back in control. Penalties are avoidable in many cases. Overpayments can be appealed, payment plans can be arranged, but silence is expensive. That is why understanding how these processes work gives you power instead of anxiety. Now, let us bring this all together in a way that gives you confidence instead of stress. The most important takeaway is simple. Your benefits are not randomly disappearing. Your checks are not being quietly reduced without explanation. The system is operating under clear rules, but those rules rely on accurate reporting, matched data, and timely responses. When Internal Revenue Service income records, Social Security Administration benefit calculations, and Treasury payment systems line up correctly, everything flows smoothly. When numbers do not match, the system sends notices. That is not punishment. That is correction. Here is what this means for you. Review your Social Security earnings record every year. Keep track of part-time wages and report them accurately if required. Understand how individual retirement account withdrawals affect your taxes and possibly your Medicare premiums. Open every letter from the Internal Revenue Service or Social Security Administration and respond before deadlines. Keep copies of tax returns, 1099 forms, and important notices. These are small habits, but they protect a very important income stream. Most penalties do not happen because someone did something wrong on purpose. They happen because of misunderstandings or delays, and misunderstandings are fixable. Let me summarize this in the clearest way possible. Accurate reporting protects your benefits. Ignoring notices creates bigger problems. Understanding the rules keeps you in control. Your Social Security continues under current law. Payments are being issued. Millions of retirees receive their deposits every single month without disruption. The difference between stress and stability often comes down to information. Stay steady, stay informed, and remember, clarity is one of the strongest financial tools you have in retirement.
Yeah, grind mode on, can't kill my drive. Turn the pressure up, I come alive. Grind mode on, I don't fold, I don't quit. Hunger in my chest, every beat I commit. Eyes on the prize, no sleep till it's won. World in my hands when the grind mode's on. Wake up with a vision, I'm locked on the target. Turn pain into fuel, I'm a flame, I spark it. No shortcuts here, I embrace every test. Pressure on my shoulders, still I handle it best. I was made for the climb, every loss, every scar. Built me in the steel, now I shine like a star. If the road gets rough, I just double my speed. Ambition on 10, I was born to lead. Grind mode on, I don't fold, I don't quit. Hunger in my chest, every beat I commit. Eyes on the prize, no sleep till it's won. World in my hands when the grind mode's on. They said limits exist, but I shattered the frame. Every wall in my path is just fuel for the frame. Discipline heavy, but my spirit is free. I don't chase success, success chases me. I'm the storm and the calm, I'm the rise, I'm the proof. Every bar that I drop is the grind in the booth. Blood, sweat, tears, that's the code I trust. I don't wait for the crown, I earn it, I'm rust.